We literally just went through something that you've only seen once in 100 years. And that's why I said last night, you'll never see it again. Not you. I mean, you could. I get never say never. I mean, it's facetious, but in history, you've only seen this one time in your lifetime. It's only happened one other time. And you'll never, I mean, I don't think I'm going on a limb and say you'll never see this again. All right, so if we go back to the S&P 500, all right, we're gonna bring on, we're gonna go down to Schiller's stuff here. I love this stuff. I don't know why. I love this stuff. All right, so we're gonna show you what in March of 2000. That's the S&P 500. Now this is sans dividends. This is just price. All right, so we sans, that means without, in French, for you French speakers, that's sans dividends, 26.52. So you can see, February, we're at 32.77. So we take our trusty calculator, 32.77 minus 26.52, divide by 3277, and that's our 19% decline month over month. All right, but obviously it was more than that. It was like when you actually look at from February 15th to March 23rd, but be that as it may, we're going to go month by month. All right, so 32.77 is where we were. I mean, 26.52 is where we were at the end of March. All right, fast forward until essentially Friday, and the S&P 500 was at 39.13. All right, so 3913 minus 2652 divided by 2652. That's up 47%. Now, if you actually go from March 20th till 2020 to March 19th of 2021, the S&P 500 was up 66%, amigos, 66%. Now, check this out. All right. So we're going to go and we're going to examine the other times the market got smoked, going back to the Great Depression. All right, so we basically have four significant instances. We got October 2007 to March of 2009. But again, we're just looking at a year-over-year time frame, 12 months. All right, so October 2007 to March of 2009, we had a great fall. Then we're going to start in March 2009. Then we had basically August of 2000 until basically March or February of 2003. All right, with another great fall. So there we're going to start in March of 2003. It'll make sense in just a second. Then we had 1973 January to December 1974, and that's it. And the only other time, amigos, was the Great Depression, which we'll get into. So let's go back, and what we're going to do here is we're going to say, okay, and I wrote it down here. So October 2007, I just want to show you here. There we go. 2007 October, right there. All right, the S&P 500 closed at its highest for the cycle at 1539. Fast forward to March of 2009, it was down to right there, 757. All right, so it fell from 1539 to 757, and we can take our trusty calculator. It fell 51% during that time frame. 51%. March 2009 to March 2010, it went from 757 to 1152. 1152 minus 757 divided by 757. It was up 52%. So it fell 50%, and then it came back up 52%. All right, but again, we were up 66% in this last cycle. So from March 9th of 2009, or March of 2009 to March of 2010, the S&P 500 was up 52%. From being a little bit more specific now, from March 20th, 2020 to March 19th of 2021, we're up 66%. So again, these are sans without dividends, just FYI. All right, and that was a pretty big shock that heard around the world. All right, so then we start in 2000, and we're going to just show. The down doesn't really matter so much, but in August of 2000, S&P 500 closed at 1485, which was the highest until we get back. I'll show you here in just a second. It fell all the way until February of 2003, right there, 837. All right, so February 2003, it fell to 837. Fast forward to February 2004 is at 1123. February 2004 is at 1143. So 837 to 1143 is a 36% increase. 837 to 1143 is a 36% increase. That's not enough. And it didn't reach 1400 till right here, about 5 years later. Then it just got crunched. Anyway, so far in the 2009 to 2010 to the 2003 to 2004, we're what we just went through tracks better in terms of the incredible, insane movement up, skyrocket, the rocket ship. All right, so then we're gonna go back to 1973 and 1974. Now, 1980s, we had a little bit of a decline here. I mean, it was recessionary, but it wasn't. So you can see right here, that's 1970s. We go to 1980s real quick. So basically from 19 right there, April 1980 to April 1981, we're up about another 30%. I mean, that's a lot. Don't get me wrong, but it's not what we just went through. I'm telling you, this level of growth is preposterous, which is fantastic, but it's still preposterous. All right, so 1973, January, 118 is the S&P 500, to 1974, December, right, right there, 67. So we went from, what do we say, 1973, 118 to 67. That's a pretty significant, that's 43% decline. All right, so then we go from 67 till 1975 to 88. So now we go 88 minus 67 divided by 67. That's 31%. So that's a lot, but it's not 66%. And that's pretty much it, man. I mean, then we go back to the Great Depression. All right, so let's go back to we have some, you can see, we got a 1948 S&P 500 was at 1430. Crazy, right? But just nothing like what we've seen at all. I find that nuts, how insane. This is, if you're not, I don't know, investing for the long term. All right, so let's go back to the Great Depression, which would be 1932. So the lowest we had was 1932 at $4.77. The markets used to trade in pennies, by the way. I mean, not in pennies, in eighth. I think it was eighth, and then they went to pennies. Isn't that interesting? But anyway, so actually, I guess that I don't know why they got 4.77. I guess maybe because of the trade. So it used to be like 4 1/8, 4 1/16 or something like that. Now it's in pennies, which makes sense. Yeah, it does make. 1932 June, we had 4.77. Now remember, we were all the way up to 25 right there. 1930, 27, 1929, 30, 1929. I think that's the highest. Yeah. So 1929 September, we're all the way up to 31. And then we fell all the way down to 1932 to 4.77 right there. So we were at 31 minus 4.77 divided by 31. We fell 84.6%. Freaking nuts, man. So 4.77 on June of 1932, June of 1933, 10.39. That's a 117% increase. 117% increase. That's the only time the S&P 500, going back to the Great Depression, has given us a more of a rate of return than what we just had. Now remember, the S&P 500 was down 84% previous to that. S&P 500 was down previous to this decline. This run up was down 35%. So just you can see the level of volatility the S&P 500 had back then relative to the level of volatility in terms of the down and the up. And what we just went through here, where the down was 35% or so, and the up is 66%. It's absurd. And look, I'm not saying it's just it's amazing. You're literally going through history. No one alive today, I hate to say no one, but I mean, my goodness, you got to be an old man to be an investor. So if you're investing back in that time, all right, you would have to be, 2021 is, you would have to be at least 20 years old back then. So we go back to 1932. We're in 2021 minus 1932. You'd have to be you're in about 110 years old. So I feel safe to say no one who was investing back then, no one who's investing today has ever witnessed what we've went through. It's crazy. A once in a 100 time. It's nuts, man. Once in a century, and you just went through it. It's crazy. This is what I tell people. I said, look, you don't understand. This last 20 years no one has ever seen this before. The only other time has been like this is the Great Depression. I'm just telling you, no investor today was alive and investing during the Great Depression. It's just not happening. So you saw this huge decline from 2000 to 2009, backed by this huge run from 2009 as April to today, backed by a once-in-a-lifetime decline in 33 days where the market is down 35 points, percent, not points, percent, and then a once-in-a-lifetime run for the last year. It's a once in 100 years, and you went through it. So if you've been investing, you've literally have more knowledge by your experience than the vast majority of investors who came before you. It's crazy. Now wait, put that in your pipe and smoke it. It's good stuff. All right, love to hear your thoughts.